I am going to start the session on beta decoupling pair trade technique. It is one of the best technique for pair trade which has proven itself from the past 9 years. So month on month basis, if you can just go on tracking this particular method, you'll know that this is one of the best method for the pair trading, and pair trading's aim is to buy the cheaper stocks at a particular time and sell the costlier stock available at that particular time. So, and the more about this beta decoupling technique, what is the maximum profit calculation, what is the hedging ratio, what is the maximum loss calculation, everything you will find out on my book on futures and option. There is a chapter I have dedicated for this particular technique, and it is one of the flawless technique which has proven for a period of 9 years, and it is my own technique. It is not being documented by anyone, so it is a technique which is being solely innovated and copyrighted by me only. So here what we used to take. So in this particular technique, what is the beta? First we have to understand what is the beta. So beta of a stock is nothing but the sensitivity of one stock with respect to the other stock. Suppose if I am taking two stocks 1 and 2, how sensitive the stock is for the stock 2, that is your beta. The relationship of the sensitivity parameter of two stocks is known as your beta. So this sensitivity, whenever I am talking, though it will have many literal meanings, however in the stock market context, if I'm saying that 1 and 2 having a beta of 0.5, so the stock 1 and 2 having a beta of 1.5 positive, that means if the stock 1 moved by 1%, the stock 2 will move by 0.5%. If this movement is in upward direction, then other also will move in the upward direction. If this move in the downward direction, then the other also will move in the downward direction. That is known as your sensitivity. So in mathematical terms, when I will start speaking, so the stock 1, which is presented in the first part of the pair, is known as your independent stock, and stock 2, which is present in the second part, is known as a dependent stock. So while choosing two stocks for this particular method, the independent stock should be a stock having a higher volatility as compared to the dependent stock. So while choosing a index with a stock, whenever you are taking a bank nifty with a banking stocks, then the bank nifty or the index which represents the entire sector, so that index will be always independent, whether it will have lower volatility as compared to a stock, because it is having a domination over a particular stock. So this rule you have to follow, independent and dependent. Then you have to calculate the beta of a stock by taking past 10 days data. So whenever we are talking about the beta, how to calculate the beta? So covariance of x and y, we used to take covariance of x and y divided by variance of x. So variance of x. So where x is your independent stock, y is your dependent stock, and this entire thing has to be multiplied with a factor called n divided by n minus 1. So n is number of days. So we are taking 10 days, 10 divided by 10 minus 1 is 9. So X is an independent stock, Y is a dependent stock. The stock X will having a higher volatility as compared to the Y. If the stock X is a, or whenever this relationship of beta is established between an index and a stock, the index will be always prime. It should be considered as X. So this is known as your beta decoupling, beta value. Once you find out this beta, so you are finding out yes, X is having X and Y having a beta relationship of 1.5. So this is the result. You will get one number which will be rational in nature, maybe 0.5, 0.1, 0.2, 0.3. So any number. So you are getting 1.5 x and y relationship. Means when the x will move by 1%, y must move by 1.5% if the beta is coming to 1.5, because this is the relationship or sensitivity parameter between x and y. So it is a mathematical things you have derived, but that doesn't mean that market will obey this one. This stock is moving by 1% means others should move by 1.5%. You must not call to the exchange and say that no, my beta is saying that it should move by 1%. You are forced to move by 1.5%. No. So market will never obey that thing. Suppose market is giving that if 1% it has moved, it has just moved by 1.25%. So that 0.25% which is lagged by this point Y stock is known as your decoupling. You have expected 1.5, it has moved by 1.25, so it is decoupled, negatively decoupled from its peer. Same way, if it is moving by 2%, you can say that it is positively decoupled by 0.5%. So decoupling is nothing but as per the beta relationship what you are expecting. If that doesn't happen and it moves in a different order, then first we have to calculate the beta by taking the past 10 days data. Identify the decoupling. If any decoupling persists, then you have to find out. So then, and predict the trend as per the volatility. If you are utilizing the volatility, it is well and good. And if you do not want to utilize volatility, you can ignore the second part of this one. And post this decoupling, whenever this decoupling is negative -1 to -2, decoupling value -1 to -2 negative, then buy the dependent and sell the independent. Buy the dependent and sell the independent. Whenever this decoupling value is +1 to -2, that you can say that buy the independent and sell the dependent. So independent is nothing but the instrument. If it is an index, it is independent. If the two instruments are from the same sector like future and stock future, then the stock which is having the higher volatility. So this is what you have got about the beta decoupling. And if it is +1 to -1, then you have to hedge it by 100%, you have to get it. So now just I will show you and you will get some amazing result out of this thing. It is a very simple rule but very very powerful rules. So these 5 points of the rule, if you just see in the real picture and if you add somewhat correlation into it, then you will get some amazing result in that. Here what I have taken here, I have taken the State Bank of India and Bank Nifty, State Bank of India and Bank Nifty. These two stocks I have taken. So I have taken this particular thing for October series and I am taking from the day it is available for the October contract. So 31st July onwards, this instrument of Bank Nifty and SBI was available for the trading. I am taking from the 31st July onwards and just going to test that things. So every day basis, what is the percentage of changes Bank Nifty has given? Every day basis, whatever the percentage of changes the SBI is being given. Based on that, I have just percentage I have calculated, and post calculating this thing, I have just calculated the covariance divided by variance into n divided by n plus 1, n minus 1. So it has given me the beta. So beta value of this thing. Then this is the beta I have got. So this column is beta and this you can say beta expectation as per the. So this first record, if you see here, the first record which is on the 13th August, what we are getting, beta is 2.01, Bank Nifty is a sectoral index, it is independent, SBI is dependent. So based on this beta of 2.02, beta what we have calculated by covariance divided by variance into 10 divided by 9. So this is as per the value of 13th August. So 13th August, Bank Nifty has moved by 0.92%. 0.92%. So as per this beta, the State Bank of India should move by 0.92 multiplied with the beta. So State Bank of India should move by 1.88% as per its beta relationship. But in actual, the State Bank of India has moved by 1.16%. So how much beta decoupling or lagging is that? 0.71. 0.71 percentage of lagging is there. Then correlation also I have taken into account, that I will talk in the last part. So this is the first day, 13th August, we have got the decoupling is minus 0.71. So this is not our comfortable zone. Next day, because we required -1 to -2, that zone it has to enter. Next day, 14th August, if you take into account, it has gone to the beta, which is the trailing 10 days data. Trailing 10 days data has given you the beta of 1.53. As per the beta, you have expected 4% move on the State Bank of India, when the Bank Nifty has moved by 2.64%, but decoupled by 1%. So these two things, if you add it, previously it was 0.71, previous day it has given, today it has given -1. So this says that this is a negative decoupling of -1.73, which is a very comfortable zone to enter the trade. Very comfortable zone to enter the trade. So -1 to -2 level we want. So what we have to do? We have to buy this dependent, buy the State Bank of India because negative, buy SBI and sell, and we have to sell the Bank Nifty. Bank Nifty we have to sell, and SBI we have to buy. So this is what we have done. So this is what we have to do. So once we have done this particular thing, once we have done that particular thing of buying the Bank Nifty and selling the, sorry, buying the SBI and selling the Bank Nifty, what happens next onwards? So this decoupling I have told you that -1.73. Very next day on the 17th August, if you see 17th August, your decoupling was point plus 3. So from negative 1.73, if you club together, you have come to positive 1.7. If you club all three together, 1.77. So what is the net impact it has created? You just see. SBI, which you have bought at 272, gone to 282, 10 rupees you have gained. If you say that it is a 1000 is the lot size, some 10,000 rupees you have gained here. And the Bank Nifty, which you have sold it at 19,040, 19,040 got to 19,049. So here to 19,049 it has gone. So you can say that only 9 points you have got. So around some 1,800 rupees you have lost it here. So net you have received 9,200. When this beta decoupling, which was negative, converted to positive. So at this particular day, suppose if you are going to enter a trade, so what will be your trade? It has become positive 1.77, positive +1 to positive -1 zone you have entered. So you have to buy the Bank Nifty here and sell the SBI. So this tendency, next day this Bank Nifty and SBI, this tendency has again increased and you have gone to 3.85. Very next day you have started contracting 2.56. Again furthermore you have just expanded and going on from positive 1.77 if you have entered. So you can say this tendency is continuing till 3rd September, when this also this positiveness is still there. So you can say on 4th September, you have come down to negative territory. So if you have entered a trade of buying State Bank of India, buying Bank Nifty and selling SBI, so you could have most probable trade will be 281 level, you would have sold SBI. Next trade 281 you would have entered. First trade you have seen 9,200 profit has come. So next trade, if you see, next trade could have been entered here. Sell SBI. This is sell. So this is 281.75. You have bought Bank Nifty. Bank Nifty also been bought at 19,000. 19,049. So based on the beta relationship. So this particular things is coming to 4th September, you are entering to this negative territory when it is coming to 16,264 and 226. So 226 to 16,264. So if you see here 19,000 minus 16,264. So you have lost 2,700 points here, and here this minus 226 minus 226, you can say 55 points you have gone. So though it is a very extreme move happened, you have not gone to a great negative territory. So 1,000 point you have 1,000, if it is a lot size, you have made profit this much into 25. If I'll say that you have just means made this thing. However, your losses will be at this particular time is only 13,000 rupees. Just from here, from the point of your 17th August, you have just expanded net basis, and till 4th September, you are just entering to the negative territory, just entering to the negative territory, 4th September. So just entering to the negative territory here, means negative is 0.02 negative. So once this negativeness will expand, your profitability will increase. So here too, you can say that again it become positive, becoming negative 0.64. So this will be the ideal case. You can say 231 to 16,800. If you say, you will be getting some benefits in that. So by this process, if you uh, go on checking these things, whenever beta decoupling expands from your point of entry, you make losses. Whenever the beta decoupling contracts as per your expectation, you make profit. So this process of contraction of beta decoupling, expansion of beta decoupling, or the variation of beta decoupling from negative to positive or positive to negative happens throughout the month. Throughout the month, this kind of things happens. So throughout the month, this particular things happens. And why it happens, that is also very important. So why it happens, this decoupling of the beta, why from sometime it is negative, sometime positive, sometime zero, why it happens like that? This is because the largest player, who are the FIs and mutual funds, whenever they churn their portfolio, churn means they should not exit the entire one stock and took any other stock. So whenever they see any beta value, based on the beta multiple, any stock is having a excess price, when they churn their portfolio, this kind of opportunity is being created. This kind of opportunity is being created whenever the mutual funds or FIs go for a distribution mode or for the accumulation mode. So whenever this distribution is happening, you are going to know this distribution pattern well in advance on the same real-time basis itself. If you take this pricings, real-time basis itself, you can able to know this particular value, and real-time basis itself you can take in action. So this is only on the historic data I have just demonstrated to show that how powerful this method is. So when there is a great fall of 2,300, 500 points happen in the bank nifty also, your losses are very very less, and that also after a couple of sessions you would have seen that it could have been converted to a profit. So whenever you are taking a beta decoupling, so net basis, now if you say 24th, 25th, 21st October, if you just see, now we have a positive 3.42. Whatever the carry forward beta decoupling is there from the past 3 months, that is coming to positive 3.4. So based on that, if you see point 3.4, so positive beta decoupling means you have to positive beta decoupling means you have to buy the independent and sell the dependent, +1 to +2 level. So it is above +2, so you can think of buying the bank nifty and sell the SBI. So if you see the lot size basis, the contract value should be same, so that your lesser money should be involved in that particular trade. Whenever you are finding out that to hedge it completely with 100%, then you have to see the contract value. Suppose sometime you have to say 2 lots with 3 lots, sometime you have to take 1 lot with 1 lot. So like that way, sometimes you have to do a lot adjustment to adjust these values. And to enhance this is a decoupling has come and everything is well and good. However, one thing if you just see very carefully, then you can make very good money in this particular method, that is correlation. So whenever you are initiating this particular strategy, correlation should be below 0.75. Correlation between these two stocks should be above 0.618 and below 0.75. Once suppose you have initiated the trade, post that you are finding out this correlation has gone to 0.949593 or 0.75 above it has crossed, then immediate basis you have to hedge it. Immediately you have to hedge it with the help of some options so that further damage cannot be done. So whatever damage is done, that will be restricted there itself. As long as it is there 0.618 below, you can get comfortable gain. So no need to worry for that. Once the correlation moves, you have to hedge it. Or correlation fall below 0.618 and you have already entered the trade, so then also you have to hedge it. So that hedging with the options is recommended when the correlation is not favorable, so that will enhance the profitability of your things, and it is not going to impact anyway. Suppose if you can say, now this the same example you just see we have taken for the past 3 months. So here we have entered when it was 0.81 87, no problem. 0.75 we adjust the threshold, 82 75 70. So immediately after this day 21st August, when it was 18,000 this thing, 74 was there. However, here itself we have 16,900 you have fallen, 246 this one has fallen. So you can say 0.87 it has become 0.87. So here one emergency of hedging the trade is highly required. So in on 21st August, whenever it has happened, so 0.74 or 24th August, whenever this thing has happened. So if you are seeing that 0.87 has happened, now to hedge it. So then if we can say that it has gone above 90, gone to 90, 91, 93, 94, 95, like this way it is going on continuing. So 8th October onwards, this correlation has started falling down. So till this point, on hedging with writing of options or some with some call options or something with respect to your volatility parameter or with respect to one standard deviation parameter, start hedging at that point of time. Once this correlation comes to a comfortable zone, which is currently for comfortable zone for a couple of days, now you can say past 2 days it is again entered to the 0.85 and 86 zone. So that time also you need to hedge. So hedging only to enhance its profitability. Hedging is not required whenever it is in the comfortable zone, and this particular method is highly powerful. And if those who are utilizing our pair trade software, same concept we used to give in for the intraday basis. Intraday basis, whenever you analyze any pair, so on that particular intraday time, what is the opportunity exists in that particular pair, it says, and it is very much effective in the intraday trade. So and also highly riskless you can say. If your direct trade is going to give you a great loss, this can save a great part of your loss. So those who are using the pair trade software, you can say that they have a intraday analysis whenever you go for that. So it is beta decoupling, whether what is the decoupling value is there, whether that decoupling is allowing some specific things to specific trade to initiate. Bank Nifty SBI for intraday it is not recommending anything, but for Bank Nifty Axis it is recommending, and for SBI and Axis also it is recommending. So sometimes it is recommends without option hedging, sometimes it recommends with option hedging, or sometimes correlation says that you should not enter a trade. So this kind of things, this kind of trades also, this is a automated things we have given here, but similar kind of things you can simulate in the Excel sheet to test this particular things. Those who are utilizing our pair trade software, They have this particular tool. This is based on this particular concept. You can very well test this concept. I have shown you two incident. One is a very light case scenario. Another is a very extreme case scenario when your prices has fallen very badly from 4th September, you can say. So 3rd to 4th September, if you just check this particular pricing, though it is a very great correction happened in both the counters, but impact was very lesser, very less. And once, and you here too also certain users, those who have used this technique, what they used to say, certain pairs they are following for particular year long period. So they knew that suppose they have entered a particular pair when the correlation, when the beta decoupling was plus 2 and correlation also favorable. This plus 2 has become plus 4. So they used to accumulate one more pair. Impact is less, only 10-15,000 rupees loss. If you cannot carry, then you cannot do an futures and option trade. So they accumulate one more pair. Suppose if it is further goes to 4-2, you can say 6 or 8, 2 to 3 times beyond it never expands. Suppose if it goes, then they used to accumulate one more. Like this process, they go on accumulating, and whenever the condition prevails, they used to hedge it, and preferably that hedgings happen with the writing of the options, most preferable way of this thing. Then once this particular trades start giving that decoupling moves in the opposite order or with your anticipation order, you have entered at plus 2 level, you are expecting it should come to 0 or negative. So you can say when you are at plus 4 or plus 8 level, from there if you have started retracing back and come to a 0 level, then it has the chances to give you a great return. Great return, that return may be a unexpected return which cannot be just through one pair trade. It may be a very great return at that particular time you can get it. Or else go on searching specific pairs. Whenever any extreme case scenario you are observing, market has fallen by 500 point, gone up by 500 point, or any extreme move has happened, post that you just examine that pair whether any such beautiful opportunity exists which is beyond plus 2, it has taken the decoupling, or beyond plus 4 it has taken, or beyond -2 or -4 it has taken. So this thing also you can enter, but the detailed calculation of the profit and loss, detailed calculation of your hedge ratio, detailed calculation you can find out in the book. If you have that book of futures and option, there one chapter I have developed means dedicated for this. You can get that detailed calculation there. And WT Gans method book also I have given the same concept. That too also if you have, you can read that concept for detailed calculation of profit and loss. So you can get to know what is the profit and loss. So before going to your question and answer, let me explain couple of minutes our products and services. So the product what you are, the concept what you are seeing in that is available in our future and option course and pair trade software. So besides that, this pair trade software also exists in our smart IT all-in-one tool, wherein along with the intraday positional tool, you also get this pair trade tool. Besides that, we have 11 products totally. Besides that, 9 more products are there. So all having some unique concept on that. So all our books and materials have the unique concepts, but we have transformed from the existing concepts. We have never manipulated the concept. We have never changed the beta formula at all. We have just utilized the beta how it can be helpful for a trader. Same by all our technical concepts, intraday concepts, without manipulating, corrupting the original idea of Fibonacci, Gann or Iliad. We have just enhanced that particular method for the betterment of the traders. So these are the things which differentiate our courses from others, which is just other courses are copycat, but however our things is based on a proper research, and this is provable. You can say that this Excel sheet, once I will start sharing with you, not only these two pairs, take off any pair, 4 5 pairs, 10 pairs, you take it for the past 3 months, 5 months, whatever data you have, just put it here, test it, test it this particular concept, then you conclude that how powerful this concept is. So there are nothing is, but though it is the crude form of this technique, no, logical conditioning is being done. However, the software has done a logical conditioning of all those things. So that is how the software is different from the crude concept. So this is how our products are, and all these products at a stretch, if you are purchasing, it cost 17,500, and this particular pair trade product comes to 7,500, and smart IT it comes to 8,500. So this concept is a very rich concept for your pair trade, and it is a proven concept. Why the beta decouples, why beta again recouples, so that has a valid reasoning behind it. And you cannot call and ask all FIs what you are doing, all mutual funds what you are doing, which one you are selling and which one you are buying. However, some frontline counters, 5 or 10 counters, if you can take and estimate the beta decoupling in this order, you will know their behavior on particular counter. That is also is a very valid reasoning is there behind this technique to make it successful. It is not successful from the past, means it is successful from the past 9 and odd years, not because it is just a beta, because you are going to get the information of the majority stakeholders of this market mathematically in front of you before they initiate any action. So you have to initiate the action before they initiate any action. So this is how this method is being done. If any question is there, Yogi is asking, this is a very fantastic question he has asked here. Can you take this migration or give a decoupling from positive to negative? This is his question. So I have already messaged to all of you. Can you define the stop loss? This method we need to hold, means from positive to negative or negative to positive. So here if you see, it was a negative decoupling gone to 1 minus 1.73. We initiated the trade. Fortunately, in the next day itself, it has gone to positive by 100%. So you are negative 1.73. From there, you jumped to positive 1.77. So that converted to a great profit. Next day, that same positiveness has expanded. Suppose if you have entered the trade here, so you would have bought the Bank Nifty and sold the State Bank of India. Next day, it is expanding. So that too by 100%. So which was 1.77 becoming 3.85. So here your loss also is increasing. So Bank Nifty what you have bought, that is also in loss. SBI what you have sold, that is also in the loss. Very next day, that positiveness of 0.385 is reducing. So you are getting little comfortable place, but still you are not in profit. So still next days, if you see, it is going on expanding, gone to 4.22. If you have entered at positive 1.73, it has gone to positive 4.42. So you are at a loss only. So once that positiveness increases and you have entered a trade in the positive direction, means you have bought the independent and sold the dependent, and that positiveness is increasing by 100% or 50-60% from your point of entry, your losses are expanding. Whenever that positiveness is reducing, your losses are reducing, or you are entering to a small profit. So this is how this trade is going on. So this is not the a trade where you can put a stop loss and come out. Yes, suppose if you want to quit the trade and come out, that is not called as stop loss. Rather, you can say that if you want to quit the trade and come out, suppose you have entered the beta decoupling when it is 1.75, positive 1.75, and this positiveness gone to by 100 basis point, means 1.75 again it has gone, so 3.5 it has become. So you will be at a loss. So this is a 100 basis point of expansion, you can come out, because from here if it further moves up and down, then you will be at a great problem that losses will expand. So but you can utilize these things for the accumulation, and that accumulation can give you a profit 0.35 level. Whatever the new pair you are entering, if it is come to 2, you are getting a profit. But it is being said that this expansion never moves beyond 3 times. Suppose 300 basis point before means beyond that it never moves. Suppose 1.75 you enter, maximum 300% on that. So you can say to 4 to 5 or 5.5 whatever is coming in that 5.5 level of expansion it will come. So from your point of entry, if you can patiently wait for one third round of that 5.5 and there you accumulate or you start hedging, then it will be meaningful. So that also you can take into consideration while entering the trade. Hence, you should enter the trade when beta decoupling contracts. You should not do the trade in the intraday basis. So this is we have to take the value of Bank Nifty, and I need the value of Bank Nifty open at 17,865 gone to 17,996. Say opening price I am taking 17,865. So till previous day my beta decoupling was 3.4233. This was the decoupling. If this beta decoupling increases, then only I will be entering the trade. If it contracts, I will not enter the trade. So opening basis I am seeing 17,865 for the day. 17,865 it has gone. Then same time if I just see on the SBI part, SBI part. So opening price I am taking. This high also you can say. So 252.85. So 252.85, 252.85 you have got. So if you just look into this parameter, so previously you had a beta decoupling of 3.42. Today's action itself, opening action, if you will take in the opening of that thing, it has come to 2.81. 2.81. So this is not an ideal case to enter the beta decoupling trade because beta decoupling is contracting. Imagine, suppose if you can say that this has opened at 17,600. Imagine this is the thing happened and your beta decoupling, this has opened up to 252.85. Beta decoupling which was 3.42 expanded to 5.66 on opening basis. Then you should enter a trade. So enter a trade whatever it recommends. It recommends to buy this Bank Nifty and sell this one, you should enter. So whenever this till previous day what was the net decoupling was there, today based on the opening what kind of action it is there, whether beta decoupling is expanding or contracting. If it is expanding only you should initiate the trade. If it is contracting you do not have to initiate the trade. This is how the intraday judgment on beta decoupling is being done. So that is what our software also does.